Okay, so I think we're ready to go here. So once again, I apologize for the delay. We were unable to get logged into the FX Street webinar page from the internet. So just a little bit about myself. My name is Greg Firman. I've worked in the futures and Forex markets for the last 12 years. In 2006, founded E-Trade FX. I am Series 3 Commodity Futures and Series 34 Retail Forex license and registered with the NFA as a commodity trade advisor. I've worked as an advisor to large hedge funds and individual traders worldwide, providing daily consulting for short, medium, and long-term trading, while also providing very specific risk management models with preservation of capital the primary focus. I have further worked as a market analyst with TraderPlanet.com since 2008, a prominent free social media website that globally connects traders, where I provide daily commentary to a large number of followers in the Forex and futures markets. Now, to get started with today's presentation, I'm just going to check and make sure everything is good here. Looks to be okay. If there's any issues, please let me know with audio, etc. Now, today's presentation is Intermarket Analysis Weekly Outlook for November the 12th, 2014. We're going to be looking at intermarket correlations in today's markets, a review of some of the major pairs and how to apply intermarket analysis. We're going to combine intermarket correlations with supply and demand areas for premium entry points, trading the range and how to play the breakout, and of course multiple time frame analysis, short, medium, and long term, with proper stop placements as an emphasis. Now, again, what I want to talk about and what I've talked about in previous webinars here, guys, is intermarket correlations and how in basically 85 to 90% of the time, no matter how good you think your indicators or how good we think our indicators are in calling market direction, a lot of times what will happen is we'll take a trade and then suddenly it goes horribly against us. And the average trader doesn't understand why that happens. So what we're going to do right now is we're going to look at what we should really be looking at when we're trading for the Forex markets. We want to put aside some of the conventional stuff, conventional oscillators, conventional moving averages to some degree, and certainly we should be really looking closely whether we should be even applying Fibonacci, Elliott wave, some of these things, because a lot of times they're constantly producing false signals, particularly the Elliott wave formation. I spent years looking at that, and I've never really met anybody who's successfully traded using it over a longer period of time. Now, it's not that it doesn't work, and maybe it does work for some people, but what I'm saying is that in most cases, that the we have primary indicators and we have secondary indicators. Our primary indicators should always be the intermarket correlation. So what's happening in one market is absolutely going to affect another market. We see this day in and day out. So let's look at some of these correlations and see what we can come up with here and what we should really be looking at. Now, some of the major currencies, in my respectful opinion, that drive the Forex market, of course, the US dollar, the King dollar, the euro, the British pound, and the yen. Any trade you are taking outside of that, guys, is somehow spinning off these. Pound, yen, euro, CAD, great. I could go on with all these wild and wacky cross pairs. They all come from the US-based majors. Bottom line, so if the yen is going up, the yen across the board is going up. If the euro is going down across the board, in most cases, the euro is going down across the board, even in the cross pairs. It's just that much more volatile when we trade these cross pairs. So the US dollar index, you'll see again, I always talk about this each month. Windsor Broker, guys, very easy to set up a demo, a lifetime demo. I've had a demo here for over 10 years. I've never traded a nickel with these guys and probably never will. But their live demo is quite amazing because it gives us the US dollar index, the S&P 500 futures, gold, light sweet crude oil, virtually everything we need to do intermarket analysis in real time. Some of the major equities, it's a little thin on those, but there's other companies out there like Vantage FX. There's a number of different ones that offer the major indices, which we can use those. So when we're trading, guys, the dollar index, a lot of brokers, not a lot of brokers, but several of them, particularly FXCM, have come up with their own version of the dollar index. If you're trading pairs like Euro US and US Swiss franc, the broker version of the dollar index is virtually useless because it's taking into consideration, first of all, it's man-made. Second of all, it's taking in under other currencies that are not trade weighted. The euro is trade weighted to the dollar index. Basically, 65% of the dollar index, I believe, is the euro. So how could we not be looking at the real dollar index, which is the DXY? So when we do our assessment on the dollar index, we can see that the dollar's had quite a rally. Over the course of these presentations that I've done, the dollar has seen some very strong moves off of the demand area, even now in the monthly time frame. You can see that we've had 3 consecutive months of higher highs. So we really want to look at price action, supply and demand. So supply and demand right now on the longer time frames, there is still demand for the US dollar. Their supply has not been filled. When supply fills, it will look something, let's come back here so we can see it. This is a good indication of supply and demand. So on the dollar index, you can see that the trend lines are drawn in based on current price, not past price. We connect from current price and then we go back to historical price. We need to know current price. How do we draw this trend line? With my own direct clients, I provide them with an indicator that visually you can see it. You can draw it yourself on here, though the MT4 is very good for that. So we look at our high point right here. We have 2 candles to the left, 2 candles to the right. That creates a supply area right there. And then we go from right to left, not left to right, okay? Right to left, and then we go to the next highest point and connect it. So we have a high point here, 2 candles to the left, 2 candles to the right that are lower than this highest point. This creates a trend line, a supply line. Supply is filled, price goes down. The same thing on the bottom, but in reverse. We have 2 candles higher to the left, 2 candles higher to the right. Then we connect it to the next lowest point. This creates a demand line. So on the 4-hour time frame, using multiple time frame analysis, we can see that the dollar index is sitting on a demand area. Remember the basic forms of supply and demand, what they mean. When there's demand for something, price rises. When there's supply is filled, price goes down. If this demand line is broken, then price will continue to move lower. Right now, that is not happening. So when we start moving out towards our higher time frames, we can see that there's a bit of a top forming here. A lot of people will use Bollinger Bands, all kinds of different things. I personally prefer Donchian bands because they commit to a price and they go. If you ever notice some of these other bands, they just kind of wander around. They never really commit. This is a nice horizontal black line right here that forms and tells me, okay, there's resistance at this area. So supply and demand, price action, support and resistance, these are things that make money in trading. Because again, remember, we have, when we talk about Fibonacci, oftentimes the trader is using a Fibonacci number to fight the current market because they're saying that the market's going to come to a certain point, hit 61.8, and then it's going to retrace the other way, when so many times the trader gets stopped out, including myself over the years. The Fibonacci has had some decent runs, but it's lost more money, in my respectful opinion, than it's ever made. But people continue to believe in it. So, if you're looking at Fibonacci, keep an eye on 61.8. That's the only number that really matters to us, okay? So when we look at this, we're still pretty bullish. We got a bit of a top forming up in here, so we're seeing some people probably taking profit. As we move out into the weekly time frame, we can see here that we've broken through. Supply is not filled yet. Now, in the weekly time frame with the dollar index, a bit of a concern for me, but we're still early in the month, is for this week, we haven't made a new high yet. So we can see last week, the high for last week was 88.30. The high for this week so far is 88.14. So I would like to see a new high put in place here. It may not be to this week, it may not be next week, but by the end of we would like to see it keep making those higher highs, and that's what we would look at from a point of essentially advance and decline. Is it advancing or is it declining? It's not advancing right now this week. It hasn't yet. That's not to say that it won't tomorrow or Friday, but we would like to see it go higher. Now, when we look at it on a month-to-month basis, the question is here, is price advancing? The answer is clearly yes, it is. We can see each month we have advanced higher. So and that includes already the month of November. So you can see that by using multiple time frames, we get a pretty good feel for what the dollar is really doing. So on a month over month basis, is it advancing or is it declining? We can see back here we've had 1, 2, 3, 4, 5. We've had 5 months of steady decline, but then we had a substantial move lower. So that makes me a little nervous here, right? Because I can see a pattern. I've got, if I'm to draw this in so everybody can see this, I've got my 5 move up right here, and then I've got 1, 2, 3, 4, 5. Sorry, there's 6 here. So 6 steady months of price advancing, but then we had several months of price declining. So can the dollar keep this rally alive? Well, is it getting a little tired? Maybe, yeah, we'll see that. But we're going to talk a little bit more about that as we start to bring intermarket analysis and some of the pairs into this. Now, what I'm looking at here is Euro-US. How am I going to trade Euro-US under these conditions? Is it really going to keep going lower like what everybody says? The market seems to be split. One group camp says it's going a lot higher. The other camp says, nope, this thing is going to 115. Some of the analysts, even here on FX Street, have been calling for sub-parity. Don't think so, but it's possible. It's certainly possible. But what we're looking at more importantly is the intermarket correlations here. So obviously, when we put the dollar index here using this intermarket analysis software, we can see that's what I'm looking from this software is to tell me exactly what is going on. Where are the correlations in the market? What should I be looking at when I'm trading the euro? Should I be looking at a single market chart of the euro-US currency pair like this and then slap 50 different indicators on here to try and figure out where it's going to go? Absolutely not. And I'm going to explain to you why that doesn't work. Okay, it doesn't work because the other markets are driving factors of the euro. So the first thing we want to look at is the dollar index. We can see that the correlation is 100%. Okay, the U.S. Treasuries, are they a factor? Yes, when the Treasuries are going lower, that immediately affects the euro. Okay, you can see there as the U.S. Treasuries rise, here the euro goes lower. There's different correlations happening. But one of the biggest correlations that I think are grossly overlooked is the European equities. What does the euro like? Does the euro want strong European equities or does it want weak? If the European equities we can see are strong, then we absolutely want to be selling euro-US. Selling euro Great Britain, selling euro against some of the major pairs. We can see that the correlation here is absolutely indisputable. Right? So there's a question here, right there, where the equities start to move higher, the euro goes sideways and then plummets. But what else are we looking at here? What else is a driving factor of this euro currency? So far, we've looked at the European equities, we've looked at the U.S. dollar index. We can see a pattern forming here. But one of the most overlooked correlation, and I even hear people saying that this correlation no longer exists. That is simply false. Gold, when we're looking at gold, let me just see something about no volume. Okay, you guys can sort that one out. Okay, again, I'm just trying to check questions here because I know I was a little late getting on here. Okay, everything's cool there. Okay, so the gold, guys, we got to look at gold. If you're trading the euro, if you're trading the yen, if you're trading the Swiss franc, if you're not trading gold, you're stuck in single market analysis. If you take that and you apply Fibonacci, you apply Elliott wave, you apply stochastic, RSI, MACD, all these things, how many times has the perfect signal on those charts gone horribly against you? What the driving factor right now with the euro, when we look at this, is clearly gold. When gold takes even the slightest bit of a move to the upside, the euro immediately responds. Euro-US goes higher. So, of course, the gold and the dollar index, the inverse correlation there, but the correlation to the gold to the euro, particularly the euro-US currency pair, is literally, it's 90, nothing's 100%, so I'm not going to say it. But you're in the upper 90s, mid 90s, the correlation. Again, right here, as gold starts to sink, you can see that this is going down. I have this chart just on a 3-month time frame, so we can view it. So that brings us to our current situation with the euro right now. So should we trade the euro based on the euro chart, or should maybe we be looking at gold to see what's actually going on with gold? So as we come over to the gold contracts, we can see right now, I'm going to come down to this on an intraday basis, and I'm going to show you guys essentially how you should be trading the euro against a broad number of pairs, particularly the US dollar. So if we look at this right now, is gold bullish or bearish? That's the first question coming out to the longer time frames. In the previous webinars, I've talked extensively about the 1236 level. 1236 represents the yearly opening price for gold. That's what it is, right? So you can see I've drawn a straight vertical line. I've got a date here that's December the 29th, 2013. This price is very important to me. Just like these candles up here, the monthly, the weekly, the daily, I always want to know where the market is trading in relationship to the open of that particular candle. Do I care about the H1, the M30, or the M15? I could care less. Do I care about the H4 all the way through to the monthly? I most certainly do. Okay, your big money traders, your big banks, all these guys, they're not fooling around down here in time frames of 1 hour and under. They're looking at these longer time frames for stability of price. So when I look at this right now, gold has actually been above its yearly opening price. Now, here's kind of the comic relief I'm going to use about Fibonacci. When we see we've come back right here, we've come all the way up, and we've had this here, we've gone up, we've created a new supply and demand, but there's a perfect retracement on this candle. Did that have anything to do with Fibonacci? It had nothing to do with Fibonacci. There's two candles side by side on a monthly time frame. 2 months in a row, it bounced off the same price, 1236. So the bears are trying to push through that. So the theory is if you're below the opening price, it's bearish. You're above it, you're bullish. So right now, the break of this candle right here of 1236 on gold led to the demise of the euro. That's really what happened here, guys. And this was in the making for months. Nobody talked about it. All they simply said was the dollar, the dollar, the dollar. When the commodities and the European equities were actually driving this pair. That's what we want to pay attention to. Am I going to be wrong sometimes about this? Oh, yes, indeed I will be. Okay, I've been humbled many times, just as many times as everybody in the audience, I'm sure. Okay, it's never about being right or wrong. It's about understanding the dynamics of the market and how important these intermarket correlations really are. Okay, that's all it's about. And of course, making money and knowing when to just cut and run and say, you know what? This isn't working out. Cut this thing. Do not hold it until it cripples your account. So right now, with the break of 1236, you can see this white line here. Do I like moving averages? I most certainly do. The 100-day moving average, if you like a 50 or 200, what have you, knock yourself out for sure. They do carry some level of significance. Absolutely they do. So the Donchian band sitting there, it's broken. Right now, my price target for gold is down here around 1075. If I'm right and it goes down to 1075, if gold goes to 1075, guys, that's going to put the euro realistically around 118, 119. So if somebody asks me a question, or one of my clients asks me a question, says, Greg, where is the euro really going here? Where do you think it could go, and what's that going to affect? Then the first thing I'll do is I won't answer one single question about the Euro-US chart. I will immediately go and discuss gold, or I will discuss European equities. We noticed last Monday, for example, with Euro-US, the euro spiked hard above 125. The ECB released a statement saying they lowered the growth forecast. The European equities plummeted. Euro shot through the roof. Guys, don't misunderstand that intermarket correlation. Can you always forecast it happening? No, but you can. Usually the price is being worked in, okay? So we want to take that into consideration, okay? Also, it lost, George is saying, also recently it lost 1180. Wow, George, you are dead on the money, my friend. You hit the nail. That was the next thing out of my mouth, is when it lost 1180, that is the level that I've been talking about here on these webinars for probably the last 4 months, that if we lose that level, we're going lower on gold. We're going higher on the dollar. That's it. So 1180 is dead on the money. We broke this trend line right there. That's 1277. But if we, that was the start of it. And when it started going lower, it just didn't stop. Right here, 1183 on that 100-day moving average, it really needed to hold, and it didn't. So right now, if we look at gold, and if you were to ask me, Greg, what is the next move on the euro? My response is going to be when this wedge formation on the H4 time, in order for the euro to go higher right now, gold must go higher, but it's sitting there at 1171 as current resistance. On the D1 time frame, there is support forming down here at 1128. Nothing goes straight up and nothing goes straight down, guys. The markets don't work that way. There are natural taking profit, things of that nature. Do we want to call it Fibonacci? If you want, it doesn't matter to me. But what I'm pointing out to you is that the fact is that the next move today and tomorrow and Friday is going to see if we can push through this H4 time frame. So we look at a sequence of events that leads to a shift in the market. So gold could retrace again, just like it did that I just showed you. These retracement points on the monthly time frame. A natural retracement point would be, once again, not just on coming from the top down to the bottom, but coming from the bottom back to the top. Does this number have anything to do with Fibonacci or Elliott wave or any of these, a MACD, a stochastic? It has nothing to do with any of those things. It has to do with, that's where the battle line is being drawn. So a natural retracement, we could see gold come back up to 1230, 1235, maybe 1210. And then I can guess to you guys what's going to happen there. The big money guys, they are just going to hammer this thing back down to probably the area that I talked about, 1070. They're just waiting to get a better price. They'll move with the market from week to week, month to month. And these are the guys that are consistently making money. So right now, we've got to look at this gold contract very, very closely. You can get you can get a gold chart free from Windsor, from FXCM UK, from Vantage FX is a good one. Vantage FX is a really good one because it's got the European equities too. It's got the CAC 40, the DAX 30, the Nikkei 225. Everything we need to make money in Forex is right there for us. But we have to unclutter our charts. This chart is very, very uncluttered. I have an RSI, an 8-period RSI. I've got a 100-day moving average and a 10-day moving average. And then I have my supply and demand areas. And I'm keeping an eye on these numbers up here. So right now, gold is down considerably on the month. It's down, that decimal's off. It's $41. It's down, right? On the week, it's having a horrible week here. The daily, it's not having a great day. So, it just gives me a feel for, but you can see these numbers turning green here. There is some money coming into gold here. And you can see as it does, here's the Euro US, very sneaky. We're starting to rise higher. So for this thing really to gain any traction, we come back down into this. So even if we look at the 1 hour time frame, I would never trust a 1 hour time frame in trading, guys. I'm sorry. That's just me. If you like it, terrific. I don't. This H4 slows it down just enough for me that I've got price stability. So 1171, if I was going to call a failure today, that's probably where it's going to be, somewhere around that area. But if we can push through there, then in the short term, I would be okay with buying Euro US. So you can see that my decision to do this is based on what happens. Can gold rise? In order to take the pressure completely off the downside on the Euro US, what I'm going to tell you here today is it's a simple response from me. The European equities need to fall, right? Step one. Step two, gold prices need to go higher, and they need to get above 1236 and stay above 1236. If that happens, then no problem. I'm easy. I'm not, I'm okay with going ahead and buying Euro US. Sometimes I think my clients think I'm nuts when I turn and say, okay, no, we're good to go on longs Euro US, and they're like, I don't want to go long. Everybody's going short. If everybody's going short on Euro US, chances are it's not going to stay down for very long. There's recently a client just sent me a thing today where, with some of the big banks, Barclays and these guys getting nailed with massive fines for manipulating the Forex market. Very interesting read that my client Graham sent me this morning, that I had a quick peek of that before I came on the webinar. Very interesting stuff. So, these types of manipulations, it's certainly interesting to say the least. So I want to make sure, because we are short today because of the late start, so I got to keep moving here. So we've looked at the euro, and the euro, that's what we're looking for. So what we're going to do is we're going to change gears a little bit here, get over to the pound dollar, because basically I've said we've got four major currencies here we've got to deal with, and everything is going to spin off of that, right? That's the key thing. So what we're doing is the British pound, US dollar, everything runs off of this, guys. British Swiss franc, British yen, Euro, Great Britain, Australia. I could go on for 5 minutes here about all these cross pairs, and they are all viable trades if you get a feel for how you want to trade the British pound itself. You need to know what their correlations are. Is gold correlated to the British pound? It is, but this is not a huge correlations. They can move in different direction. The correlation is about, I'm going to put it at about 70%. They're still very strong, but it is nowhere near as strong as some of these other pairs like the Swiss franc, the yen, which I'll be talking about in a minute, and of course the euro. These are big correlations. So when we're looking at this, we can see that as gold continues to move lower, the British pound does, but the British pound is not moving as aggressively lower as what the euro is. And that is certainly something I want to point out. Now, the key one that I'm going to talk about that, again, I just don't hear anybody talking about, any analyst talking about. They talk about, and they've got some great, some absolutely amazing strategies. I really like, your analysts that you want to focus on are ones that focus on price action, because price, supply and demand, these fundamentals that we have to deal with every week, the non-farm payroll, the FOMC, the ECB, CPI, GDP, all these things. These are short. It's all noise, to be perfectly honest. There's a knee-jerk reaction before it, there's a knee-jerk reaction to it afterwards, and then in 80% of the time, whatever the trend was prior to the announcement, it continues a few days, a week later. So statistically, currencies are moving 1% of their value per day, guys. Don't lose sight of that, right? There's not going to be any big monster breakout plays. Breakouts in Forex happen maybe 3 times a year. That's it. A 100 pip rally, that is not a breakout. A breakout is 300, 400, 500 pips within a few days. That's a breakout. We don't see it that often. We did in 2008, but we don't see it now. So right now, getting back to these correlations, I want to make sure I get all this for you guys. Okay, so light sweet crude oil. Once again, we can get our oil charts from Vantage FX, from Windsor, free. Even you US guys, make up an address so you can get over there and just get a demo. You don't have to trade there. Just run a demo so you can see what these are doing. You can see that when oil goes down, the British pound does not like that one iota, okay? It immediately follows it down. You can see this all over the place. And, there's a little hiccup right there. You can see that oil took a little rebound on the forecasts here, and immediately the British pound responded by going higher. So where does that leave us with the British pound? Well, we want to have a quick peek at those equities too, right? The British pound, I'm going to warn everybody here though, in a lot of cases, the British pound actually likes it when the equities are going higher. It's much different than the euro, okay? It's actually considerably different at times than the euro. If the FTSE is going higher, that doesn't necessarily mean that the British pound is going to go lower, like what we see with the euro, the yen, which I'll talk about again in a second here, which I'll close up with. That's not always what happens, but a lot of cases here, like you can see this little section right there, and I've seen this in other cases where the FTSE has moved considerably higher, and the British pound was moving up with it. So it doesn't always happen, but it just something to be mindful of. But predominantly right now, the correlation is that as the FTSE goes higher, the British pound goes lower. So it is following somewhat of a correlation here, but the real correlation here. Do you want to know? Somebody said to me, an American client said to me and said, you know what? I can't get the CFDs like you guys in Canada and Europe and Aussie and New Zealand, but I really want to look at these charts, but I'm not paying $300 a month. So they look at this and I say, well, here's an easy way to gauge whether your next trading day, whether or not you want to buy the British pound or not. Okay, I'm going to simplify this down because what I'm saying is valid, and we can see it in these charts. When RBOB gasoline contracts, which is basically the price of manufacturing gas, goes down, then the British pound goes down. But when gasoline prices go higher, we can see that the British pound goes higher. And the correlation here is actually, there's very little lag in this too. And that's what we look at, just like indicators, primary, secondary indicators. We look for getting as much lag out of the market as we can. Is there a little bit of lag in that correlation with the FTSE 100? Yes. Is there very much lag on the RBOB gasoline contracts or light sweet crude oil? There's virtually none. We're talking hours. So if you're getting back to the easy way of trading this, if you're driving down your local street, wherever you live, it doesn't matter. If gas prices are rising, then you want to be looking at buying British pounds, right? That's what you want to do. If oil prices are rising, then we want to start buying British pounds. That's how we want to do that. So when we look at light sweet crude oil, again, there's very little lag in this. You know, the British pound has its little hiccups and bumps in the road, but realistically, this intermarket correlation of just looking at light sweet crude oil on your trading platform, and again, I'll bring that up so everybody can see it here on. There it is, light sweet crude oil. So this looks pretty much as ugly as the British pound US dollar pair does, doesn't it? It's indisputable. When one falls, the other one falls with it. So does economic data play into this? Absolutely. That just usually just pours salt on the wound. In most cases, it's already getting hammered by oil. And then the British pound comes out and goes, well, the Bank of England comes out the other week and goes, maybe we'll raise rates, maybe we won't. We'll let you pawn on that for a couple of weeks, you peasants. That's the way you kind of feel when these guys talk, because you're thinking, you know, he didn't really answer anything. He just kind of threw something out there like, well, we might do this or we might not. So the market's left to interpret this. And this is what I'm saying. It's noise. That's all it is, noise. When you come back to the intermarket correlations and apply basic supply and demand trend lines and base your current prices, then we get a good feel for this. So with oil, is oil having any kind of recovery? Well, when we come back down into the using multiple time frames, we can see that oil actually is starting to show a little bit of life here. So somebody asked me the other day, do I think that the British pound's going to be a good trade? So I was tied up with clients this morning. I'm sure that there's some poor economic data that came out on the British pound. But whatever it was this morning, I'll check it later. If somebody knows what it was, you can put it on here, and that's great. But ultimately, it's if oil reacts and starts moving higher, and gasoline prices at your local pump start moving higher, it's a done deal, guys. I don't care what the Bank of England says. The pound is going higher. It's going to follow those contracts, because if we go back over this period of time, we've already been hit with some really ugly data from Great Britain, but it always recovers. And again, you want to look when we're talking about oil prices, right? So if we come back out here on the monthly, you always want to kind of know, where your yearly opening price. So in this particular case, I'm going to look at it on pound dollar. When I come over here, 164.14 was the yearly opening price. So you can see that the British pound opened the year, moved all the way up. We hit trendline resistance, formed up here, and down it went. So the natural retracement point is 164.14. If that coincides with a Fibonacci number, that is just dumb luck, okay? It is not Fibonacci. This is the market like a moth to a flame. As we start moving towards January 1, the British pound will likely start moving back towards this number, and that's probably going to start near the end of the month. Okay, like, is the Fed going to raise rates in 2015? Maybe, maybe not. They said yes, but there's not going to be an aggressive rate hikes going on here, guys, like 0.5%, 0.25% per month. No way. The U.S. economy, I talked about this the other week. It's that U6 number. It's not. It's better, but it's not great. Has Obama created any new jobs since he's come into power? The answer is no. He has not. It was 9% when he came in. It's currently 11. He's been in power for 6 years. So how can he claim that he's created X amount of jobs? The U3 number, guys, watch out when the unemployment numbers come out. That U3 number is not your friend. Google the U6 number. That's the one you want to watch. That's the broadest measure of U.S. unemployment. Is it getting better? Slightly. Yes, it is getting better. Who was it better? If you look at the Bush years or the Obama years over the 8-year period, oh my God, Bush's hands down was better. Not even, you can't even argue it. The recession came in, okay, whatever. We need to look closer at what's really going on with that unemployment situation. So I want to make sure I get to everything here today. So the last one we want to look at is, of course, uh, some people's favorite, some people's worst nightmare, the Japanese yen. Guys, this is not a difficult pair to trade. It's not a currency. It's not a difficult currency to trade if you understand the intermarket analysis component of this. Somebody will ask me, what do I think of the dollar yen? And I won't even comment on it. I will comment and say, what's gold doing? What's the Nikkei doing? If the Nikkei's going up, yeah, you should buy dollar yen. So the S&P 500, there's certainly a correlation there, but it is not what it used to be. This is the animal you want to watch, the Nikkei 225. Again, your European brokers, Windsor, Vantage, they all offer this chart on a demo for free. Take advantage of it. So you could look at the Nikkei chart and say, okay, is the Nikkei having a good day or a bad day? And from there, you can make your decision. Do I want to buy the dollar yen or sell the dollar yen? Or do I want to buy yen across the board or sell yen across the board? So these correlations right here, you can see that as long as the Nikkei is going higher, dollar yen is going higher. So big money is going into one of two places, guys, not rocket science. They're either going into Japanese equities or they're going into Japanese yen. It's an either or situation here. If some Elliott wave forecasts, I'm just using Elliott wave. I have nothing against Elliott wave. I'm just using it as an example. They say they go into wave 1, wave 2, wave 3, wave 4, and then we say, okay, when we hit wave 4, we're going to hit this Fibonacci. It's all a bunch of nonsense, to be perfectly blunt, because when you look at it, the bottom line is this is dependent on a couple of different things. It's dependent on the equities going higher, and it's dependent on gold going lower. That's what determines the Japanese yen currency. So my first point to make is the equities. When the Nikkei 225, not the S&P 500, the S&P 500 has plays a part in this, but it's nowhere near the kind of correlation we're seeing now. The Nikkei down, dollar yen down. That means money is moving out of equities and they're moving into the Japanese yen. This correlation is indisputable. This is just over a 3-month period. I could go out over a 12-month period or whatever. It's still the same thing, right? So then that pesky old gold comes into play again. So we look at this again and we say to ourselves, all of a sudden gold took a spike. So that gold chart that I showed you guys, that H4 time frame, that 1236 level, these are all key things for the remainder of 2014 that you need to be cognizant of. Okay, you need to be aware of this, because if you look at gold prices, right? So gold goes higher, right? Immediately, the dollar yen goes lower. So the correlation is not only are they moving out of Japanese equities, they're moving into Japanese yen, and they're probably moving into gold contracts. That's what bigger money is doing, right? The little guy never sees this coming. So right now we see something going on with gold down here. We could be in for a corrective move higher, but unless we get above, if you're on this webinar, just jot that number down, 1236. That's all you need to know. If we get above 1236, we hold above 1236, the yen's going to start strengthening again. The Swiss franc's going to start strengthening again. The euro is going to start strengthening again, and even the British pound to some degree. This is what these four currencies drive the Forex market. Bottom line, everybody spins it, I guess, a different way, but the reality, based on what I've showed you here today, it's indisputable. So as gold plummets lower, the yen plummets with it. The euro plummets with it. The pound to some degree plummets with it. Swiss franc goes down. Now the currencies I'm going to end with and talk about briefly, Aussie US, New Zealand US, US CAD. These are commodity currencies, right? So they are somewhat dependent on oil prices and gold prices. I do like the US CAD. When people ask me questions about Aussie US and New Zealand US, believe it or not, I tend to go after Aussie New Zealand. I don't really like Aussie US as a currency. I don't like New Zealand US as a currency pair to trade because it doesn't have as strong of intermarket correlations, because they're not primary currencies, they're secondary currencies, but they are carry trade currencies. So oftentimes when the yen is weak, in most cases, the Aussie and New Zealand are strong because that's what they're doing, right? They're using the Aussie and New Zealand as a carry trade. That's what they're doing. So It's a difficult one to gauge, but it's still one to look at. Another thing we also want to look at, I just want to briefly mention, keep an eye on the U.S. 10-year notes also. You can see that as the 10-year notes rise, the dollar yen also moves lower. And then you can see it right there again. As dollar yen starts to go climbing higher, strengthening U.S. dollar, a weaker 10-year treasury note. So when we look at these intermarket correlations, these are truly what's driving the market. I've heard a lot of people talk over the years and talk and saying, this correlation is no longer relevant. That correlation is no longer relevant. That's just not true, guys. The markets repeat themselves. We know this. We know all of this. So when we look at that, we've got to take that into consideration. So I'm getting a question here from George. How would you comment on the divergence between the 10-year yields and the 2- and 3-year? There is, but the 2- and 3-year, you could almost look at these and say, it's kind of like the 2- and 3 years are more like a 1 hour, 4 hour chart, and the 10-year gives us a broader sense of it's sort of a better example, maybe even like the U3 number and the U6 number. They're both important, but the U6 number takes a broader range. The 10-year seems to be the big one. So I do look at those 2 and 3 years, but I really tend to focus on the 10-year because you can see that there's very little lag in the correlation, and the signal, George, seems to be cleaner for me, if that makes any kind of sense, what I just said. Cleaner, I don't know what that means, but it's not as choppy, I guess, is a better word than cleaner. So there is definite ways that we can gauge this on how what's really driving the markets. But the key thing to understand and know is that if you are trading the pairs that I've talked about today, and if you're a Forex trader, you're trading them. And this goes the other way too. If you're a gold trader or an equity trader, everything I said about these currencies is actually relevant. You want to, if you're a DAX or a CAC 40, if you're a European equity trader, everything I've said in this webinar here today is invaluable to you, because now you can see the bigger picture that if the euro all of a sudden starts to rally and you're in a long DAX 30 position, or you're in a short gold position, which a lot of people are right now, right? You want to make sure that you are in a position to cut this thing, and more importantly, you want to know where to cut this thing. So right now, as we look at gold, as I close up the webinar, gold is playing a very, very big part in everything we are trading, and that is certainly something that I want to make sure that the masses help to educate them and understand this, because believe me, your Forex trading will advance leaps and bounds if you understand what these correlations are, because not only is it telling us when to take a trade, it's also telling us when to get out of a trade. And most big gamblers, if you've ever been to the casino, you see these guys, you always know the ones that make money, because they're the ones that make money or make little bits of money, and they always get up and know when to leave the table. Where unfortunately the average weekend gambler that goes into the casino, he just doesn't know when to leave the table. And with these markets, they are choppy, they're thin, they're illiquid at times. Stay away from that. Whenever the FOMC or the non-farm payrolls are on, stay away from it. The following week, I didn't trade at all on Friday. My trading on Monday and Tuesday has been fantastic. I don't need the headaches of Friday non-farm payroll. I don't need the headaches of a Fed that is constantly contradicting themselves. These are not trustworthy people, guys. I hate to tell you. So, but my time is allotted. Once again, I want to apologize for the brief delay coming onto the webinar here today, and I want to thank FX Street for hosting here today, and I really want to take the time to thank everybody for coming out and supporting FX Street and supporting me, and I certainly look forward to talking to everybody on the next presentation.